And welcome everyone to another Smart Money Circle episode. I'm Adam Sarhan. With me today is Lane Kawaoka, who's the owner of Wealth Elevator, and he's bought and sold over $2 billion in real estate. Lane, thank you so much for taking the time and welcome to the Smart Money Circle.
Hey, thanks for having me, Adam. Aloha.
Aloha. So, Elaine, I know you're in Hawaii. Thank you for taking the time. I know it's early there. Please let us know your story and how you got to where you are today.
Yeah, I call it the linear path. As we were talking earlier, I went to school to be an engineer, to get a good job, to do the whole 401k. Shortly after graduating, I discovered I didn't really like the job. I was in construction engineering, so you start out as a construction supervisor out in the field. But I had a good paying job and able to, pretty frugal with my money. So I bought a house to live in. Again, this is a lot of things that we're taught to, do with our money. 401k, max out the 401k, Roth IRAs, buy a house to live in, 2.1 kids, work a 40, 50-year career. But I just kind of on the whim because I started to, work on the road all the time. And I had this big house to myself that it kind of was silly to come home on just on the weekends, just to it myself. And so I started to rent it out. And that was kind of where this madness all started, where I started this world into rental real estate.
Nice. And tell us a little about your company, Wealth Elevator, what you do and how you help people.
Yeah, I mean, so as time went by, I had 11 rentals by 2015. And then, we started to syndicate large apartment deals. I mean, I guess it started with smaller ones, 50 units, 100 units, and then it started to go up from there. We started to develop new apartments. And today we even are into private equity, buying businesses. So we kind of do a little bit of in that world. But what we started to do was, in 2016, I started my podcast, and just started to teach people how to buy little rental properties. We had, little groups where we'd mentor people. And that was kind of my passion, was to help people get off the beaten path of traditional investments into the world of alternatives, whether that's real estate or, in syndications. And then it kind of unlocked another world of, um, you know, these other tax strategies where you use passive losses to offset um, passive income, or even with rep status, real estate professional status, and then infinite banking. And it kind of opened my eyes, and I realized that there are a lot of these strategies out there that just the common man could do, but it's very alternative, very the opposite of what my parents taught me.
Hmm. It's almost like the rich dad poor dad. I hear you saying a little bit of, if you're familiar with that idea of, hey, the one dad was go to school, go to work, 9 to 5. That was a poor dad. And then the rich dad was basically did the opposite and went a different direction. So, okay, a few more questions for you, Lane. So, as you were building up your business, you started the traditional path as an engineer. You realized, hey, I can make money from rental income and investments in property and non-traditional investing, so to speak, or alternative investing. And then you came across some rental income. And then tell us the story about how you got to over $2 billion in transaction in real estate, buying and selling, and how did all that come together? And the money,
Yeah.
the leveraging, were you just independently wealthy, or did you figure out how to, borrow from banks? And, give us some color there, please.
Yeah, I mean, just a little bit background on, like, guess this is a while back ago, right? Because I graduated in 2007, started to work for the man, and I was almost getting like a six-figure salary, which is pretty good for an engineer out of college back then. I was really frugal with my money. I think that was one of my key things, is, we were always taught to buy stuff or don't buy stuff we don't need. So I think I was able to initially save maybe 30 grand, 40 grand per year. So that was how I was able to buy the first property in Seattle, Washington. Um, but then, when you start to get into real estate, you start to learn that you make money four ways. The tenant's paying down your mortgage for you. You're getting the appreciation and the mortgage built up from that. And that's the big difference of, you owning your own house and being the person paying down your mortgage, and a tenant doing that for you, plus the tax benefits and then also the cash flow that you're getting. So this kind of continued on. I started to learn more about, becoming more of a sophisticated investor, learning more about rent to value ratios, where to buy properties. And this is kind of where I transitioned from buying properties where I lived in high priced areas when I was in Seattle to places in Birmingham, Atlanta, Indianapolis. So at the time, this is like 2012, you could buy these so-called turnkey rentals where you could buy it for maybe 80 grand, something that would rent for about 900 bucks a month. So beat the rent to value ratio 1% or better, where you take the monthly rental price divided by the purchase price. Of course, most investors have some kind of an analyzer that breaks down the profit and loss, but you know, from a quick and dirty standpoint, the 1% rule is kind of a good place for starters. So that was kind of where I really started to expand my portfolio remotely. And this is all by working my day job. But part of it, I think, and when I work with clients, it's all about what you are able to save. At this time, I was a kid in my 20s, wasn't married, didn't have any kids, and I was able to work on the road, living off the company dime, off expenses all the time. So I was able to save almost 80, 90 grand, even after taxes every single year, which went directly to buying more and more down payments on all these properties. So that was kind of how quickly I got to about 11 properties in 2015.
Oh wow, wonderful. And you also came in at a good time because 08, 09, the prices have come down so much, so you're buying as they're going back up. And that was probably helpful too.
Yeah, it definitely got me started in Seattle, right? Because right now, if to start in Seattle or Hawaii or California,
Yeah,
it's just
crazy high.
untouchable, right?
Right.
But I think around 2012, that was why I transitioned from investing in my own backyard to investing out of state in these more flyover states. Because even in 2012, that was kind of when the plane started to take off. And
Mm.
it's very similar to today in commercial real estate. The last couple of years, prices have come down 20 to 30% off the peaks.
Right.
It's been pretty tumultuous in commercial real estate caused by, the people usually will get shorter debt packages in this world. So, um, but yeah, like prices started to take off and I definitely rode that wave. I knew kind of what was up. It made sense to me at the
Yep.
time. And I think that's was a big thing is, taking a look at the math and the numbers, and every investment, there's risk. But in the beginning, I think you have to concentrate, especially when you're under a couple million bucks net worth.
I couldn't agree with you more. So, two questions. One, it's a perfect segue to my next question, which is about risk. But before I go there, I want to finish this part of the story. You said you buy and sell businesses as well, not like private equity style. Please tell us a little about that. What do you look for? What's your criteria? What are some mistakes people make? So on and so forth.
Yeah, so a lot of this is, just following the breadcrumbs of other peers. And that's kind of what I've learned through the years. Like one of my biggest, I think jump ups as an investor was in 2016. Up until this point, sure, I had 11 rental properties, but I just interacted with myself. As we all know, engineers, we're all introverted for the most part, than that one out of
Right.
10 guy. And I thought I was pretty smart, right? Had 11 rentals by my late 20s. But then I started to kind of haphazardly interact with other passive accredited investors, people with a net worth of $1 million or greater. And I started to realize a lot of these guys, which were trading in their little rental properties for more scalable investments and value add deals, and this is what brought me into the apartment world and syndications. And that was kind of where I started to uncover all these other tax strategies, infinite banking with life insurance. And I was like, wow, and it was kind of fun too, right? That's kind of why, for us, we have like an annual retreat in Hawaii every year for our investor group. I'm big on community, getting around other passive investors because, nobody else really invests out there, especially people who are first generation multimillionaires. If
Right.
you're a trust fund kid and, you were born with money, as you're mentioning earlier, you're doing things very, very differently. And you already have your circle of people around you at that point. But again, like how we found private equity is just just looking around. What do people invest in after they get to this level, and what's after the next level? And start to realize that when you start to break it down, right? You look at a group like Tiger 21, and they do kind of a rollout of what their pie chart and asset allocation looks like. you look at there, it's not traditional investments that the average guy under $1 million, $2 million has in their portfolio. It's real estate or real estate syndications, partnerships, where there's sort of direct ownership there, or private equity. And then private equity is kind of one of these worlds. It's like, well, what the heck is that? And for a while there, even up to a few years ago, I was like, well, what's it? What is that? Right? We technically do real estate private equity when we syndicate large apartment deals ourselves, but what exactly is that? But so it's a huge world, and I think whenever you invest in something, you want to have some type of working background in it. So at least for myself, I've kind of been working on my website, the Wealth Elevator, over the last since 2016. I know a bit of how the internet works, content websites, um, and I know a little bit how e-commerce and SaaS businesses work in the website world. So, right now we're focusing on business M&As, but it doesn't mean we can't go buy plumbing businesses or HVAC businesses. What I've learned, especially with the real estate, is you need to find an operating partner, right? That operator is so important. And when you combo it with the money source, investors, that's when you have this multiplier effect. And what I've also learned from, going through ups and downs and bad partnerships is it's hard to tell who is a good partner until you really get into bed with them.
Right.
And that was kind of where a lot of lessons learned with the real estate projects that we've done in the past. But a lot of it has to do with like finding that operator. It always comes back to like, finding an operator with a good track record. And it almost doesn't matter what asset class or vertical you're in if you find the people who have excelled in the past.
Yeah, I love that.
So
Winners win, right? Love that.
exactly,
Yeah,
exactly.
right. So, okay, wonderful. So let's talk about risk management. What are some mistakes you see people make with respect to risk management? How do you handle risk? Anything else you want to share on that subject, please?
Yeah, I mean, esoterically, the way I look at it is you always take as much risk as you can, as long as you can live with the worst case scenario. So, for example, I don't go skydiving, right? Because the worst that can happen is the chute doesn't open and I die, and I,
Yeah,
literally can't live with that,
I'm in the
right?
same boat. Yeah.
So, how does that apply to investing? Well,
Yeah.
why do you always take as much risk as possible? Well, the theory is the more risk you take, assuming you're investing in good deals, the more risk you take, you should be rewarded with that much upside.
Mhm.
And there's a concept out there called the Sharpe ratio,
Yep.
where the more risk you take, the more upside you get. And you're typically rewarded with an outside return of reward as long as you take more risk.
Mhm.
So, of course, that's just an esoteric idea, and it's hard to determine what are the good deals and bad deals and good operators and bad operators. But it just kind of starts as a framework. And what I've always been passionate about is like just getting off of the beaten path and getting to this world of just non-retail investor returns. What I kind of realized starting out when I had little rental properties was I was making, maybe like 20, 30% returns on my money just with a simple buy and hold rental property. And this is
Mhm.
where in my early 20s, I had the Wizard of Oz moment. When Dorothy looks behind the curtain and realizes none of it's real.
Right.
And I was like, well, why the heck would I want to put my money in that 401k stuff for a paltry 6 to 8%? I got to pay taxes on that thing at some point, right? I don't want to pay on taxes when I'm wealthy and I have a high income at the end, which is ultimately what everybody's doing when they invest in that stuff. But even if you throw that out the window, just the paltry 6 to 8%, why the heck would I want to do that? And where did all my money go? And then you look to, this is kind of where you start to hang out with some fun people that maybe have little cookie ideas that might be a little bit more conspiracy theorists, but I think of it true. You can believe what you want to be. How else is Wall Street building so big and, these corporate salaries, right? Even on the direct syndication side, the operators take a cut of it, right? And they're deservedly take do so. because they're incentivized to perform on behalf of all the investors. But at what point through the layers of middlemen does it not make sense anymore? And that was kind of what initially pushed me off the traditional investment path and into this alternative world. And I don't believe everybody should have, 100% alternative investments. Some people should even do alternative investments. It's just not for them. But I've always thought if you're able to surround yourself with the right people, which is why we kind of do in-person events and we're such community based in our investor group, and you're able to, learn a little bit. We have a lot of free content, about syndication, doing due diligence. You can get that outsized return with a little bit of, work, right? Which is not that hard, especially for people who've gone and studied to college, that, they can get to this world and, reach deals that were once institutions only got. Like when
Got
we
it.
got these apartment buildings and we work with brokers, some of them ask like, what do you guys do? You guys give the average Joe access to this apartment building? And I never realized it until people said that. But yeah, we give the average Joe access to what was mostly out of reach, right? If you wanted to invest in an apartment building, you had to do it through a layer of middlemen, do like a life insurance, REIT or something like that. Sure, investing in the same thing, but it's just a bunch of middlemen taking your returns and you take all the risk at the end of the day. So I think that was kind of where, the way I see the world, if people are able to educate themselves a little bit. I think that's the hard part, right? Until you meet a group of people that, are sort of like, you know, people who see the world a little bit differently and are a little bit more sophisticated than the average bear, it's kind of tough, right? Because you're out there against all the marketing of the big Wall Street companies.
Yeah, no, I understand where you're coming from. I always like to say there's an infinite number of ways to make money in the market or in life. Your job's to find one that works for you. So I like how you saying from a risk standpoint, you look at the worst case scenario. And if you're okay with that, you'll take the investment. If you're not okay with that, you'll just pass on the deal and wait for the next deal to show up.
Yeah, I mean, there's a lot of other. Maybe I'll just give you one more. I mean, since it's sort of written in blood, right? Commercial real estate has been just tumultuous the last 2 years. The peak of 2022, 2023, with interest rates going 40-year high. I think if you invested in those years, the 21, 22 vintage projects, you just got killed with this.
Mhm.
How could you not, right? When you combine it with, short-term debt, that renews in under 5 years, which is typically most commercial real estate projects. Commercial real estate is not bought on 30-year amateur. I mean, it's bought on 30-year am deals, but loan terms are much, much shorter than that. Just how the world works. Um, and, people talk about diversifying through different asset classes, apartments, self-storage, mobile home parks, office, which, obviously office is a great poster child for something you don't want to be in, but you would have never known, right? This is all in hindsight. This is all the person saying like the armchair quarterback on Monday,
Yeah.
critiquing the game after all the cards came out in the flop.
Yeah.
So you never know what's going to happen. And so what I say is, and you never know when the market cycles are. We know market cycles typically are 7 years. Apparently, this last one was a really long one in real estate, commercial real estate. Residential real estate is still going sky high. I mean, different dynamics than commercial real estate there, but everything goes up and everything goes down, right? I mean, right now
Right.
stocks are sky high. Good investors look at what's out there and they say, well, what's been beat up?
Hmm.
And that's been commercial real estate. And it also can be crypto from another standpoint. Maybe if you don't count the last month when Trump, was kind of in there. But, the bad investors are the ones that look at past performance, the recent past performance.
Yeah, you don't
But
want to chase returns, is what you're saying.
right, but that's what every sucker does,
Right.
right? And that's why you
So
have these
most
bubbles built up.
Yeah, so what you're saying is like after every green light, there's a red light. So if you only buy the investments that have gone up a lot it's inevitable you're going to get a pullback or a decline, and then you kind of get stuck doing that and then missing out in the next move. But what you're looking to do, you're more of a contrarian, if I understand you right, is you're looking for undervalued assets. Things have had a red light where they've gone down a lot, and you're saying, okay, hold on a second here. Maybe the dynamic has changed, and there's room for the green light to come and this that investment to go up again, whatever that
Yeah,
investment asset
or
class
maybe
might
said
be.
a little bit different, like, take apartments, especially like workforce housing, where you're in a country of increasing population, especially in the lower middle class,
Hmm.
and people aren't really, if anything, they're moving more from bigger houses to smaller living quarters with, the generally lower quality of life, especially in the lower middle class. So that's a good example of a trend that will continue 10 years plus. I'm
Gotcha.
willing to put my own money on that.
Gotcha. So
So
you
you
start
look
with
for
a
those,
thesis. You want a thesis that you can
right? You
understand.
start with a working thesis like that, and you kind of
Gotcha.
go along. Some people think the same way of crypto, right? They think
Hmm.
of it more of a technology than actual like currency in a way, and that's great. I may not agree, but that's a thesis. At least you have some type of inner belief that you have, as opposed to going back and just chasing what's been hot. You're essentially that sucker who just goes around the Las Vegas casino floor, just looking at what's the hot craps table. And we know we don't like that guy, because whenever that guy jumps in the table after he
Yeah.
waits a couple turns, he's the guy who throws seven and
Yeah.
it comes out. He's that guy. And we don't
Yeah.
like that guy. But
Yeah.
if you assume that at every point there is a market cycle, and there is, then the only way you can protect yourself against this is diversifying over the time horizon in one
Right.
asset class. So
Gotcha.
spreading your investments out over at least 4 to 7 years, and then you'll be
Gotcha.
okay.
Perfect. Well, next question for you. Timeless advice that you'd like to give the audience, please.
I think a lot of it is like the people that you work with, especially when you get off the beaten path into projects where you're very close to the operator level. You're not going to get wealthy or get the returns when you work with a big institutional operator, right? I mean, a great example for that is REITs and, insurance companies. I think they give their investors like sub 5-6% returns there. Um, and they don't even pass through the tax benefits, a lot of those structures. In our world of more direct ownership of rental of uh apartment syndications, you have more reputable operators out there that have done billions of dollars of assets under management. But typically, your return on investment prospects or projections are double your money in 10 years. Still, I think better than what you get in traditional investments. But, I think when you go off to a more emerging operator or someone who just kind of are on their first dozen or so deals, you can typically find projections that are much, much stronger than that, maybe even double your money in 5 years. But there's a big area in the middle. And I think that's where people need to focus in on, right? Trying to find a good operator that's not on their first few dozen of projects,
Gotcha.
um, and that has that track record. Track record can also mean going through the ups and downs, right? I mean, especially if you've lived through the 2022-23 correction, means that too. But that,
Gotcha.
yeah, I think that's a idea of the spectrum, right? And a lot of those more institutional operators, I get it. Some people are like, well, I want to work with more when I start out into this world. I want to start with a bigger operator. Well, a lot of those minimums are going to be a quarter million, $500,000 minimum size. That may be too rich for your blood, especially if your net worth is under $2 to $3 million. My like I said earlier, you want to diversify your net worth around. You never want to have more than 5% of your net worth into any one asset, project, or thing.
Gotcha. No, it makes sense. And then, well, you mentioned earlier about being concentrated. So can you solve for X right there in case somebody's asking?
I guess, like to me, like, I guess maybe this is where I've made mistakes in the past, right? Like what got me to this world is investing very concentrated in real estate.
Hmm.
This is when my net worth was under that few $1 million threshold. And what I realize is that you hear a lot of money ideas. And this is kind of what prompted me to write my book, The Wealth Elevator, where, there's, like you mentioned, Rich Dad, Poor Dad, and, Dave Ramsey, Cece Orman. A lot of those books that I mentioned are written for people who are getting started, under $1 million net worth. Rich Dad, Poor Dad in particular, I think it's great money mindsets, right? But there's nothing tangible. What the heck do you do in there? For all we know, you could just invest in crypto and get lucky and get really rich that way. But what I wanted to do is just tell my story, how I bought rental properties, from 2009 to 2015, traded those in for syndications and private placements, get into developments, get into more private equity deals. It's part of a journey that I've kind of been on these last at least decade plus. And what I realized as I walked through these thresholds, that the kind of the goals and the mindsets needed to change. So, in my book, I have this pull-out chart of, the different net worth thresholds. And it sort of changes as you go beyond. $1 million net worth and below, I call the first floor of the wealth elevator, buy little rental properties. But once you get above that, your investment choices change. And then when you get to 2.5, 3, $4 million net worth, that's kind of what I define as end game for most people, right? At that point, you're able to cash flow and life insurance at 5%. So you should have enough. Most of our investors are pretty frugal people, especially that those are the first generation multimillionaire households. But there is a floor above that, right? The third floor, the penthouse, different ideas. And this is kind of where I've been kind of progressing and working with other family offices type of level, wealthier families, right? You're talking second, third generation net worth. But this, I've had insight into the levels above, right? As I did when I kind of started this journey back in 2016. Started to learn what people between the $1 to $5 million net worth threshold were doing. So I kind of bring that into my book, and this idea there's paradigms as you go through this wealth building journey, and it kind of depends on, well, where are you first?
That makes perfect sense. Last question for you, Lane. Can you tell us the best piece of advice you'd like to give the audience and or your 20-year-old self?
If I were to tell my younger self or somebody between, 0 to $2 million net worth, that's kind of the hardest part, right? As they say, get that first quarter million, $500,000 net worth. I still think you need to just buy little rental properties. You got to kind of, for you, that may feel like it's, risky, but when you go into 30-year AM loans and you're cash flowing from day one, you may have to buy in places that aren't where you live, because a lot of us listening probably live in pretty nice areas, more primary markets, sexy markets where the numbers don't make sense. So you may have to get out of your comfort zone and invest in some of these other areas with better rent to value ratios. But it's gonna take time, man. I mean, look, it took me from like 2009 buying my first rental to 2015 to get to 11 rental properties. But to know that there's a switch at that point to acting more like an accredited investor, getting out of high liability rental properties where the debt's in your own personal name, having to manage a property manager. Um, I'll say that the last thing is, when I had 11 rental properties, I have property managers on all my rentals doing my dirty work for me. But, the exception rate at that point is you maybe have an eviction or two every year, some kind of big catastrophe like a tree falling in your house or a storm in the basement, maybe every quarter with 11 rental properties, which is not that bad. But with 11 rental properties, that was about $3,000 of passive income a month with a few $100 per each of those rentals, right? Times 11. And most of my clients want more like $10,000 to $15,000 of passive income. So you need to multiply the exception rate by 4 or 5. So now you're talking about an eviction every other month, some kind
Yeah,
of big issue happening every like week or two, and it just becomes unscalable and a lot of legal liability down that road. But hey, if you're below that, don't worry, just do that. If you're beyond that, then maybe pick up my book, The Wealth Elevator.
love it. Well, Lane, thank you so much for taking the time and Hopefully we'll have you on again soon.
Yeah, thanks for having me, Adam.